Spanish is the language of love. Italian is the language of food. And accounting is the language of business. Accounting might also be the language of rejection. I have this English-German dictionary produced by Lonely Planet in my office, and it says that if you're ever looking to kind of quickly let someone down gently in a romantic context, you can indicate to them that before this goes any further, I must be upfront. I'm an accountant. It'll let them down easily, and you can avoid some future heartbreak by leading someone on. So accounting, also the language of rejection. But mostly it's the language of business, and it helps us keep score in an organization and beyond. As the famous management guru Peter Drucker once said, you can't manage what you don't measure. And so accounting is a super helpful tool for us to keep score in our organization. As we go through this course, as you go through other courses, I want you to keep one big question at the back of your mind and continue to push yourself and others on this. How should organizations and society measure their success? We'll be talking about a number of ways that organizations are using to measure their success, but I want you to push back on this and try to come up with your own definition and your own sense of priorities about what should be measured. So typically when we think of accounting, we think of profit and the financial side of a business. There are increasing burdens falling on accountants to take a broader view of what success in an organization looks like. Investors are asking for more information about the sustainability of the company, both from a financial perspective, but also in terms of their impact on the environment. Other stakeholders and activists, governments asking for more information about the social impact of companies. So accountants are increasingly required to take a bigger picture view of the impact of their organizations. So in this class, we're going to tackle a couple of the tools and neat techniques that are emerging to go beyond the BLING. And one of them that I am particularly fascinated with is Fogo Island's economic nutrition label. So they take something most of us should be familiar with, the nutrition label you'd see on food that outlines ingredients in the food we're consuming, and they apply that to kind of the inputs and outputs associated with the production of a given good. So in this case, looking at a bench that was produced on Fogo Island in Newfoundland, and it breaks down the cost components. So how much of the price tag that you're paying for that item is going towards paying for the labor that goes into it. It's outlining how much the product and like the raw materials associated with that good are going into it. And it's outlining very clearly where any profits that are made on the sale of that item are going. So how much money that the companies are making in terms of percentage, and where those profits are being distributed, where that economic benefit is being distributed. I think this is an incredible tool, and would love to talk more about that later in the class and how we can apply it to a number of situations, how it might change our outlook on financial decisions we're making. I'll talk a bunch as well about this concept of the triple bottom line, where we're measuring data and we're setting metrics and setting goals for our companies across social, environmental, and economic domains. So not only are we measuring whether a company is profitable, whether we can pay the bills, we're also interested increasingly in and required in some instances to track things like our CO2 emissions, things like our energy usage, the wages that we're paying employees. For example, the ratio between the CEO's pay and the lowest paid employee, and things like that. So taking a wider lens of how we measure success in an organization. And we'll spend a bunch of time in this class thinking about it, but I wanted to introduce it up front before we dive into the financial side of accounting. So when it comes to accounting, there are a lot of rules. The rules that accountants have to follow in Canada are generally set out by a few kind of governing financial reporting frameworks. A big one is that all companies have to abide by the Canadian Tax Act, which is managed by the Canada Revenue Agency. So that's kind of like an overarching body that helps us to understand the way that we have to report on financials in our country. And then there's specific accounting rules depending on what type of organization you are operating. And so those follow what are called Canadian generally accepted accounting principles. And there's a few different sort of subsections of that. The big ones that you're worried about here, if you are a for-profit business, you're going to be following either International Financial Reporting Standards, or IFRS. And if you're a private company also operating for profit, so a smaller locally owned business, you're allowed to follow either IFRS or accounting standards for private enterprises. So in Canada, there are typically 3 legal forms that most businesses and organizations operate under. We have a sole proprietorship, which essentially is a company with a single owner. We've got a partnership, which is a company owned by 2 or more individuals. And then probably the item that we're going to spend the most time on in this class is the corporation. So that's a special legal form for a business in which the company or the business is a separate legal entity from its owners, and its owners would generally be called shareholders or investors. Okay, so just breaking down a few of the differences here, and there's a lot. So a sole proprietorship is, from an accounting perspective, the business and the owner are treated as separate legal entities. Okay. So you're always going to separate business and pleasure, and that's actually the case for all types of accounting entities. If you're running a business, you want to break out your personal financial affairs from those of your business for all sorts of reasons. You can get into a lot of trouble if you're blending business and pleasure and putting personal items in through a company, so never do that. Okay. From a legal perspective, both sole proprietorships and partnerships are considered, in the eyes of the law, that the owner and the business are the same thing. Okay, so that means that when the owners of either a sole proprietorship or a partnership are filing their taxes, any income that they make within their business is taxed at whatever the owner's personal tax rate is. So in the eyes of the law, a partnership and a sole proprietorship and the individual are the same thing. Okay, with a corporation, the business and the owners are considered separate legal entities. Okay? So a corporation, in the eyes of the law, in the eyes of accounting standards, is treated essentially as a separate individual that's not linked to the person that, or the persons that run it. It's a separate legal entity. It's a person in the eyes of the law. With a corporation, business income and any income from the business is taxed at corporate rates. So the corporation is taxed separately from the individuals who own it. Okay, so some big pros and cons of each. Sole proprietorship and partnership are both pretty easy to set up, really low fees. Cons of those are that under a sole proprietorship or a partnership model, there is what we call unlimited liability. So the persons who own the business can be sued by third parties, and there's no limit to how much they can be sued for. Whereas with a corporation, your liability is limited to what you've invested. So if I've invested $10,000 into Amazon, I can only lose $10,000, and those who are suing me can't come after additional funds for the most part. Okay. Another con of sole proprietorship or a partnership is that it's often difficult to raise capital or raise funds, because there's not kind of legal protections in place if you raise that money that are offered by a corporation. And another disadvantage of sole proprietorships and partnerships is just that they have a limited life. So when the owners die, kind of the business dies, and there's no mechanism legally to transition those operations over to another owner. Okay. From a corporation's perspective, the big pros are that there's limited liability, so you can only, your kind of losses are limited to what you put into the company as an owner. It's a lot easier to raise money either through the stock market or a number of other mechanisms to bring funds in, and a corporation can live on kind of infinitely, like immortally, because it's easy to transition ownership between, like to sell off ownership to other folks to carry on the life of that company. Some of the cons of it are that it's a bit more expensive to run from a legal perspective. Just a few more filings, and it takes time and energy and cash to keep running a corporation, and you're subject to way more regulation and rules, and it's just generally way more complex to run. Okay, So those are the big three. Corporations is what we'll be talking about a bunch. To make things even a bit more confusing, but to introduce you to some of the nuances here, there are lots of different types of corporations. We'll be talking primarily about traditional business kind of in this class. So that is a corporation that has a pure profit motive, and it's aimed at kind of solving a problem in the world, but for the purpose of generating profit for shareholders. You'd also see other types of corporations like a charity, which is formed like a corporation, but has the ability to issue tax receipts, gets certain tax breaks, and exists purely to undertake a social purpose, whether it's around education or health or alleviating poverty. It exists more to do good than to generate a profit. And then you have not-for-profit companies kind of in the same boat. They don't have the ability to issue charitable tax receipts, but their purpose is to solve like a social, environmental, or gap in the community, not to make profit. Okay. So you can see here on this types of corporations lists, there's all kinds of nuance to this. We'll dive into it a little bit in the class, including that middle ground there of social enterprise where you're trying to balance doing good for your shareholders while making an impact in your community. And just one more type of corporation is cooperatives, which you may have heard of. When I think of cooperatives, the first things that come to mind are MEC or REI in the US, a outdoor merchandise provider that operates as a co-op. MEC has recently been in the news because it's been acquired by a private corporation, and it's going to be moving away from a cooperative model, which is kind of sad. I also think about Just Us Coffee Roasters, which is a co-op, a fair trade coffee co-op that was started by Acadia professors several years ago. And I think of credit unions, so a type of financial institution that is member-led. Cooperatives operate by 7 specific principles that differentiate them from a traditional shareholder kind of driven model in a traditional corporation. So they're agreeing to operate with a voluntary and open membership, so anyone can join. Democratic member control, so members are supposed to have a very active voice in the day-to-day and strategic decisions of the company or organization. Member economic participation, so splitting the profits equally across those who are members of the organization. They operate with independence, so kind of free from constraints of a broader types of constraints that you might see franchises operate under. They offer education and training and information for their members as one of their kind of core operating principles, and they cooperate with other cooperatives to form kind of a larger community as a whole. And one of their key principles is just that they demonstrate concern for the community that they operate in, or the wider human community. So that's cooperatives. Don't want to forget about them, and we'll be talking about them a little bit in class 2. So why do we need accounting, and how does it work? Overall, the goal is to provide kind of a set of common rules so that we can provide useful information to external users, or so that may be shareholders, that may be creditors. So we want to be able to provide information that's relevant and a faithful representation, so an honest account of what's happening in our company. We want to provide that in a standardized form to people that are interested in it. Maybe that's folks that are interested in investing in our company. Maybe that's people that we owe money to, like our bank. So we have a standardized set of rules that allows us to speak a common language about how our company's doing, and allows our external and internal stakeholders to make educated decisions on the information that we provide to them. So what are some of the things that accounting for financial information tells us? I mean, big picture, it's giving us the story. It's telling us the story of how an organization is performing. So how is it bringing in resources? How is it spending them? Is it being efficient with them? It's telling us what we own as a company versus what we owe. What do we have available to us? What are the big assets that we have ownership over? And what are the big IOUs that we have to external organizations, or liabilities? Can we afford to pay our bills? So are we liquid as an organization? And are we going to be able to make ends meet kind of at the end of the current period? And are we making money? Are we bringing in more resources than we're spending? So who's using financial information? We generally break it into two separate groups. So you've got internal users, and those are generally those who would work within the company. So the management, individual employees who are using accounting and financial information to make decisions on perhaps it's whether to launch a new product or not, perhaps it's a decision to cancel a product or not. We're using it to track our progress. Maybe we're in the construction business and we're building a $50 million building. Accounting information helps us to determine whether we're going to be able to afford to complete that building and whether we're ahead or behind schedule and ahead or behind on our budget. It's also going to allow us to track the sustainability of the organization, both financially and increasingly from an environmental perspective. External users, creditors, so folks that lend the organization money, and investors would be the two biggest categories of external users. And you'd also have folks like the government who we as companies pay taxes to. And so they're going to be concerned with whether we're making effective decisions with the resources that we have. Are we putting in place proper controls to make sure that resources of the company aren't being stolen, that like data is being protected, things like that. And external users are also going to be concerned with that we're complying with relevant laws like international financial reporting standards, kind of rules and regs that are set out by governing bodies on how we account for things in a consistent way across the globe. And the Canada Revenue Agency wants to make sure we're following the Canadian Tax Act so that we're paying taxes on earnings in an appropriate way. So science has E equals MC squared. Music has all you need is love. The fundamental accounting equation, like I'm talking, if you're getting one accounting tattoo, this is the one. It's assets equal liabilities plus equity. You probably want assets here equals liabilities plus equity, and you want that to balance, same as if you're at the gym, which you can tell I don't go very often. You always want to get equally swole, so assets equal liabilities plus equity. This underwrites all of accounting and is a fundamental law of the accounting universe as it currently stands. And so we'll spend a fair amount of time on that in this class. To break that down a little bit, you can think of it as it's ALE, assets equal liabilities plus equity, pretty easy to remember. So assets are anything of financial value that a company owns. So something that's going to provide us an economic benefit into the future. Liabilities are the things of value that a company owes to other parties. So essentially an IOU or an obligation to pay something in the future. And shareholders' equity or equity, that's the amount of assets that are owned by the shareholders of the company or that are owed to the shareholders of a company. So liabilities owed to a third party, and shareholders' equity is owed to our shareholders or investors. Okay, so going to do a lightning speed rocking through the financial statements just to get you familiar with them. I'll do a number of problem walkthroughs that you can kind of follow on as we build some from scratch. Just want to get you familiar with them. We're learning a new language, and we're just going to dive into the deep end here and introduce some of the anatomy and things you want to look out for on your financial statements, and basically why we have them and why they're important. So there are 4 big financial statements that we're going to deal with primarily in this class. And the names of them can be used interchangeably, so you'll hear a bunch of different names for each of the financial statements. And just really important to understand the fundamentals of each and how they flow together. So the first statement when we're looking at the financials of a company that we would either build and generally want to analyze is the income statement. So we can think of this as like the story of the organization's performance over a period of time, usually a year. So it's telling us what the organization earned versus what it burned, the revenues that it brought in versus the expenses that it had to incur in order to earn money, and if there's anything left over, at least on paper. Okay. We've got the balance sheet, which one of my personal favorites. It tells us at any given point in time the fundamental accounting equation for that company. So It gives us a snapshot at a date or a specific point in time about what the company owns versus what it owes. We've got the statement of changes in equity or changes in retained earnings. And that is essentially the story of what's left over at the year end and available to be paid out to shareholders, or what's owed to investors. So what's the accumulated profits in the company, less any dividends that we've paid out to shareholders, what's left over for our investors or our shareholders. And finally, fantastic statement here is the statement of cash flows. And that is telling us the story of where the organization's cash came from and went over a period of time. So under what we call accrual accounting, we're tracking transactions when a substantive event has taken place and not necessarily when cash has come in or out of the organization. So on the income statement, we could be showing a huge profit in the company, but they may not necessarily have actually collected any of the cash associated with selling goods or services. And so the cash flow statement is where things come home to roost, and we can see whether the company is actually generating cash going into the bank account as a result of their operations and other activities. And at the end of the day, they say cash. Diving into the income statement, some fast facts here. We might refer to this as the statement of operations, or the P&L, or profit and loss statement. It's telling us the story of how an organization's performed over a period of time, and it essentially lets us know on paper whether the organization is making more money than it is spending. So whether it's operating at a profit or at a loss. And the key equation that we're always looking for when we look at an income statement is revenue minus expenses equals net income. So what we earned versus what we spent, is there anything left over? And again, this concept of it being an accrual world, so transactions are recorded at the time they occur, regardless of when cash is received. So if you want to think about this, perhaps you have placed an order for season tickets, and you don't have to pay for them until you've attended a couple of games. The company's going to recognize a source of revenue, or recognize a transaction when they've started providing the service and are entitled to revenue in a nutshell. So even though no cash may have come into their bank account, they can still recognize revenue because a substantive event that's given rise to a transaction has occurred. So anatomy of an income statement. At the top, we are always starting off with revenue. We can think of the income statement a little bit like a country music song. So things start off great. We start off with the good news, revenue, and that is an increase in the amount of resources an organization has as a result of providing a good or a service. So we're buying and selling, or we're selling goods, or selling services. Revenue or sales is what would turn up at the top of our income statement, recognizing that there's a flow of resources into our organization. So like a country music song, we start with the good news. In a country music song, we're starting off, we've got our truck, it's working great, our dog's with us, we're going fishing, and we're in love, and things are going great. And then things get progressively worse, kind of like an income statement. So we've got our revenue accounted for, we jump into expenses next, and then we start subtracting or decreasing the amount of resources that we have available in our organization. And expenses recognize that we're parting ways with resources in order to provide the goods and services that we've earned revenue on. So we have to pay our people, we have to pay for the goods themselves, and any number of other things, taxes, interest on any loans we have. And so expenses reduce the amount of resources in our organization. If we subtract expenses from revenue, we get net income, sometimes called net earnings, sometimes called profit. And that's what's left over if we subtract our expenses from our revenue. So we could be running at either at a profit or a surplus if we're a not-for-profit organization, or we could be running at a loss. So diving a little bit quicker into revenue here, there's a ton of different ways we can analyze financial statements that we'll dive into in this class. So revenue, again, an increase in resources, cash or in kind, or a promise of future resources coming into an organization from selling goods or services, commonly referred to as sales. And we can break down, and we want to understand how a company's doing in its revenues by breaking revenue down into all kinds of different categories. We could look at what product line or service line it's coming from. We could look at what geography that those sales are being generated from, and break down revenue and each of these line items that we see on our financial statements. We can get into the weeds. This is a very high level story. Financial statements are kind of a tweet or a single social media post about how a company's doing, and we can get into huge amounts of detail on each of the categories that are presented to us. But revenues are the inflows of resources happening, and they're coming first. Expenses, decreases in resources coming to us. Again, we typically list them in descending order from largest to smallest, and we would always calculate income taxes last. We calculate that based on what we call our earnings before income tax. So if we take our expenses, eligible expenses, and subtract them from revenues, we would calculate our income tax on kind of the interim profit that we make. There's all kinds of rules around that. And net income is usually what we're honing in on the income statement. It's telling us if an organization is spending more than it's making, and we calculate that just by subtracting total expenses from total revenues. So it's a profit if revenues are greater than expenses, and it's a loss if expenses are greater than revenues. And our goal for most organizations is to have more revenue than expenses and to be in a net income but positive position. Okay, so that's the income statement. Tells us the story of an organization's performance over time. Tells us on paper whether the organization made more money than it's spent. And when we're analyzing it, again, we want to look at and understand if we're comparing the organization's performance year over year or against organizations in a similar industry. We want to look at some of the big trends and ratios that are occurring within the relationships between numbers to see how they're doing relative to prior periods in their organization and how they're doing relative to kind of similar organizations that operate in the same or similar industries. Okay, so next up, I'm going to dive into the balance sheet here, some fast facts. You could say it's a whole lot of BS. That stands for balance sheet, get your mind out of the gutter. So it's often referred to as the statement of financial position, and it tells us at a given point in time what we own versus what we owe. And it basically allows us to know kind of whether an organization can afford to pay its bills, and we can draw some conclusions on the liquidity of the organization. It doesn't tell us what an organization is worth on the open market, but we can get some hints about the value of an organization through looking at its balance sheet. So in terms of anatomy here, the balance sheet is where we find out about the fundamental accounting equation of the company. So we learn about what assets it has, the things of value that the company owns, and then we learn about what it owes. So a company's assets are going to be either financed by liabilities, so amounts that are due to third parties, or they're going to be financed by amounts that they owe to investors or their shareholders, which is the resources that are kind of left over after we've subtracted our liabilities from our assets. Throwing a lot at you, don't worry, this will become clear in time and we'll have lots of practice together. Okay. The fundamental accounting equation always has to balance. Okay, so assets always must equal liabilities plus equity. And looking at it another way, equity is essentially what we have left over after we subtract our liabilities from our assets. So if we take the value of all the things that we own and subtract what we owe to third parties like creditors and lenders, what's left over is shareholders' equity, which is essentially what we owe to our investors or our shareholders. Okay. So looking at some balance sheet anatomy, assets are always on the top of the balance sheet, and we list items in order of liquidity, so how quickly they can be converted into cash. The most liquid asset is not water. Please never write that on a test. Someone always writes it on a test, even though I say don't write it on a test ever. The most liquid asset is cash. That's because it's the resource that's most readily available to us. We list assets in order of liquidity, so cash is typically listed first, and then closely followed by accounts receivable. So that's like an IOU from our customers where they promise to pay us cash in the near future. And they go from most liquid to least liquid. So towards the bottom of the balance sheet, you're seeing kind of, the asset section. You're seeing bigger ticket items like property, plant, and equipment. So buildings are less liquid than cash because we're going to hold on to them for a longer period of time, and it's tougher to convert them into cash in our pocket. Okay. anatomy of a balance sheet. So we're often breaking out our balance sheet into current assets and then longer term assets. So a current asset is a thing of value that a company owns that can be expected to be converted into cash within a year. So some common current assets, we've got kind of cash itself, whether in electronic form or physical cash and bills. Things like we might call marketable securities or investments like stocks and bonds. Those are considered current assets because it's pretty easy to sell a stock or trade a stock in for cash to get access to cash. We have accounts receivable, so again, IOUs from our customers. Someone's taking advantage of a service early and has promised to pay us cash in the near term. Another common current asset is a prepaid expense. So maybe we've paid in advance for our rent, and so we've got an asset available to us as we've already paid for that service, and we're going to take advantage of it in the next couple of months. And things like inventory are typically current assets, so items that we're holding on to and intending to sell in the short term. So merchandise, for example, things like clothing, if you're a clothing company, would be considered inventory and a current asset because you hope that you're going to be able to sell it quickly. We've also got non-current assets or longer-term assets, and those are items that we expect are going to generate value for the company in a period of over a year, or that we're going to be holding on to for the longer term and are tough to convert into cash. Okay, so with this, kind of some common examples would be any furniture, equipment, so computers, desks, shelving, through to buildings. And land are all considered examples of longer term assets, just things we're going to be holding on to for longer than a year. They're going to add value to our company and we're going to use to generate revenue well into the future. So diving into the bottom of the balance sheet now, we jump over to the liabilities section. And so liability is an obligation of an organization to give up resources in the future. So think of it, it's an IOU. We've accessed resources and we're going to have to part ways with our hard-earned cash to cover bills into the future. Liabilities are listed in the order of when they are coming due. So we have current liabilities, so bills that are we're gonna have to pay within the next year, or obligations we're gonna have to meet within the next year. And then we've got non-current liabilities, so things that we're gonna have a longer time period to pay for. So some of the common liabilities we'd have out there on the current side of things would be accounts payable. So those are IOUs that we might have to a supplier for goods that they provided to us in advance and we haven't paid the bill for yet. And we typically expect to pay those bills within a couple of weeks or months. Taxes payable, so amounts that we owe to the government, is another common type of current liability because we're going to want to pay that off within a year to avoid getting into trouble. We have accrued or deferred revenue. We'll talk more about that later in the course. But that is for when we've been paid upfront for a service. So someone's given us cash already, and we haven't provided the service or the good yet. So we have a liability to provide that service. So that turns up as a liability on our financial statements. And some of the longer term non-current liabilities we might have would be things like bank loans or mortgage and leases, where we've borrowed a more substantial sum of money often and are paying it back over a multi-year term. Diving into the shareholders' equity section of our financial statements here and of our balance sheet. So equity is essentially what we owe to our shareholders and our investors, and it's the amount of resources available to distribute after all of an organization's bills have been paid. So two big sections here. We've got contributed capital, and so that line item basically tells us the amounts of money that investors have put into the company. So they've given us money to buy shares in our company, usually at the time of startup, so we have enough resources to get a business off the ground. And then they may invest further money in order to help the business grow. So they are trading us resources in order for a share of the future profits of the company and the ability to vote on the direction of the company. So contributed capital is the capital or the resources that investors have contributed to the company in order to partake in a share of future earnings and to help determine the direction of the company. Retained earnings is, think of that as the cumulative either net income or surplus or loss of an organization. So the built up profits over time that they've generated through operating the company. less whatever we've paid out to shareholders already in the form of what we call dividends. So shareholders or investors, they contribute capital to start the company, and then hopefully the company earns a net income and then retains some of those earnings, and then they would repay investors through what's called dividends. So dividing up some of the profit of the company and then reinvesting some of the proceeds, some of the earnings in the company over a longer term to help grow the company. So that's the balance sheet. Okay, it's a snapshot of what an organization owns and owes at a specific point in time. Fundamental accounting equation at play here. So assets always have to equal liabilities plus equity, and we can ask questions around how are we valuing the assets. So when we look at the list of all the items in the asset sections, are they worth what we say they are going to be worth? Are they worth what they're listed at? Or is there an issue where maybe due to some particular circumstances, think climate change, think the pandemic, are assets that we've held at a certain amount now worth less than they were before? We want to be asking the tough questions. And a balance sheet is also going to be able to tell us whether we're going to be able to, whether we have enough assets to cover off our liabilities, so whether we're going to be able to pay our bills or not. So we're going to jump into the statement of cash flow, some fast facts here. So this is telling us, it's explaining how cash has changed on the balance sheet year over year. It's telling us kind of the story of where our cash came and went over a period of time. And it gives us insights into whether the company is actually kind of generating cash from its operations. So the income statement it can tell us if a company is operating profitably on paper, but if that's not translating into cash in our bank account, we can't keep the lights on for very long. So cash flow gives us a hard reality check sometimes on a company. And it gives us a good true picture of the sustainability of a company from a financial perspective. So we've got three big sections to our cash flow statement. Again, you're drinking through a fire hose here, but all good. We're going to spend the next couple weeks getting to know all of these statements really well. So the first section of the cash flow statement is called changes in cash from operations. So that is the section where we start to, we would start with net income of the company. So they said they made profit on paper. We start to pull that apart and look at what aspects of net income actually resulted in cash coming into our bank account versus going out, and did the profit we said we made on paper actually translate it into cash in our bank account. So it gives us an insight into, on a day-to-day basis, from the core operations of the company. Is it actually making money from operating its business, or does it have to rely on outside funding from investors or a bank in order to keep the doors open and the lights on? Okay. The next big section is changes in cash from investing. So that's going to help us answer the question, did the company buy or sell any big property or equipment, or did it make any big investments or sell any big investments during the year? And so did it have to spend cash, or did it earn cash from any of those activities? So that's the investing section. And next we have the changes in cash from financing. So did the company take out or repay any loans during the year? Did they issue shares? Did they pay back their shareholders? So financing activities are highlighted here. So whether we had to part ways with any cash to repay loans, pay dividends to our shareholders, or whether we brought in cash from selling more shares or from taking on additional loans and debt. So on the cash from operating activities side of things, again, we always start with net income, and we're looking to adjust that for what actually came in the form of cash, and it adjusts for some of the sources and uses of cash from day-to-day activities. We call this our working capital, and there's a close relationship between this and the current assets section of our balance sheet and the current liabilities section of our balance sheet, where we look at what the changes in those accounts were, and then we can figure out what the kind of cash impact of various activities there are. If you wanted one takeaway or one kind of key thing to be looking at when you're looking at a cash flow statement right out of the gate, number one question you want to ask is the line that says cash or changes in cash from operating activities, is that number bigger than our net income? Okay. And if cash or changes in cash from operating activities is bigger than net income, it's a good indicator that we're actually doing a good job at converting or turning what we say is a profitable operation. We're actually turning that into cash in our bank account. So we're backing up our claim of profit with cash coming into our bank account. Okay. So the next big section on this one is is cash from investing activities. So here again, we're looking at outlining some of the major sources or uses of cash for big capital investments. So buying things like equipment, property, land, and whether we are outlaying any So the investing section, looking really at, are we investing in like property, plant, equipment, land, big ticket items, big ticket assets that help us with the future of the company, whether we're spending money on those or whether we're selling them and generating cash through that. And so we often, if we were to jump to the cash flow from investing activities section, we might see that number be negative or a really big one. We generally want to be investing in the future of our company. And so if this number is negative, that's not a bad thing necessarily. If we weren't investing in kind of upgrading our equipment, upgrading our property, then we would kind of fall behind and end up with old assets that weren't super productive. So don't be alarmed if cash from investing activities is negative. Okay. Final section here is cash from financing activities. So this is outlining the major sources and uses of cash for a company by raising money through like selling shares, or taking on debt, and it also would capture whether we are like buying back shares in the company or repaying debt, and whether we're paying dividends to our shareholders. So cash flow statement, probably the most complex of the statements that we're going to look at in this class. We won't look at till the end, but just know that it's the story of where cash came from and went, divided into three big sections: operating, investing, and financing. And we really want to hone in on the cash from operations section and whether or not net cash or net change in cash from operations is bigger than net income. And if it is, then generally speaking, we're in a good spot. And overall, the cash flow statements can tell us whether we have more cash than we started with. So just threw a ton at you there, okay? That is a quick primer on the financial statements, encouraging you to read in depth what you've got in the book and match that up with what I've just talked about and give a try to the exercises that I've outlined in your weekly checklist. Happy to go over this in more depth. Don't worry that this feels overwhelming. We're learning a new language, and this is a very quick hit lesson on what to expect in each of the financial statements. So give the practice problems a try, and definitely read the chapter and follow along the examples with that, and you're going to get this in no time.